When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events, what's going on in the headlines. Also, do alternative investments belong in your portfolio? We'll answer listener questions, and then finally, why your estate plan should change. My name's Jeff Shade. As always, just here to ask the questions, but the words of wisdom is solid advice. They come from the other Jeff in this radio program. It's Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
Doing great. It's always good to be with you.
Always good to be with you as well, Jeff. And of course, always good to be with our great listeners here in the greater Tucson area, and also those people who do join us up in Mesa. Jeff, it feels like the markets have been riding a roller coaster lately, from inflation data to Washington drama. When you look at the next couple of weeks, Jeff, what are the key things that you're watching out for most closely?
Well, the market's getting incredibly unpredictable. I mean, for a while, it's still, even though it's insanely overvalued, for a while, it seemed a little bit more predictable with the AI stocks taking the lead, a lot of the chip stocks taking the lead. You can always still count on NVIDIA, not so much anymore. If you look at the last few months, it's been pretty flat. Yeah, there's been a lot of things that have sold off. I mean, earlier this week, we had gold fall 10, 15%. Yeah, most of the gold-related and silver-related stocks earlier this week. That was kind of a shock after it hit 4,300 right before that. I think it was last Monday, and then it just started tanking. Now, I think we're going to see some resilience in the gold market, but things like that kind of rock our senses as far as what's really happening here. You know, is gold really on a tear, or is it just some profit taking, or is somebody manipulating the market? And what I have seen is there's a lot of market manipulation when you look at the difference between the spreads between the bid and the ask price. The ask price being the retail price and the bid being the wholesale price, for lack of a better definition. But usually when you buy a stock, let's say at $100, and if you wanted to sell it immediately, you could get $99.99 for it. Basically, you lose a penny or so. Lately, you could buy a stock at 100 and the bid is $98.79. I mean, you're losing $1 at 1%. And so the market makers, the banks and the brokerage firms, are just laughing all the way to the bank because they're selling and they're creating this spread where if they could drop the bid and get people scared, start selling, they make more money, and then they get to buy cheap. Not just that, they continue to exacerbate that sell pressure by lowering the bid even more. And the market makers are directing a lot of this emotional sell-offs because there's so many what we call tourist investors in the market right now, people that really don't know fundamentals, never really did anything other than they hear on the TV, buy the dips, buy the dips. Every time it goes down, you're supposed to buy it, and it goes down and you buy it. And then all of a sudden it keeps going down because the market makers go, haha, let's watch this. Then they get them all scared. They shake them out. They buy low, and then it goes back up again. So there's a lot of that to deal with. Now, you can either just kick back, buy and hold, close your eyes, and not let the gut ache bother you. But the thing is it's so overvalued that one of these sell-offs may be the real thing, or it may be a time when it gets bad enough that there's margin calls where people who have borrowed money to buy stock have to sell more stock in order to pay off their debt, because it's kind of like loan sharking the market. I think I can see my own account is a margin account. I mean, they'll loan me money against my stocks. I think they're loaning me way more than they've ever been able to loan me before. Now, I don't necessarily take the loan. Sometimes I will in a quick trade, or while I wait to put more money from my bank account into my brokerage account and so forth. But they would let me leverage my stocks so that if there's a 20 or 25% market correction, I could lose all my money. I mean, that's pretty scary. So there's a lot of things that concern me. You said, what do we have to watch out for going forward? The fact is the market is not only overvalued, it's being manipulated in ways that are characteristic of pre-crash stuff that's happened back like in the dot-com era, where anything with a dot-com was being manipulated and people were getting suckered in, and then all of a sudden the crash happened and the smart money moved out and the dumb money lost a lot and had years and years to catch up. So I think we have to be respectful of the market as always. Now, having said that, our portfolios are still well up for the year from the standpoint of the risk on portfolios, beating the market so far, even with some of these crazy sells. But that doesn't mean they're going to stay up. That doesn't mean this is predictable. It's getting less and less predictable. In other words, early on, right after the election, Trump could say a certain thing and we'd know kind of where the market might turn. Now we have this quantitative easing coming back with Jerome Powell. That's usually a sign that the market's weak. So smart money's thinking, there's a telltale sign that maybe we're at the end of the road here. But the dumb money or the less sophisticated investor doesn't know that. So they're still buying in. We had a kind of the indication. Jerome Powell earlier this week said that he thinks inflation is in check and he can go ahead and continue to lower interest rates. Well, lowering interest rates might help the stock market because it appears to be a good stock market friendly thing. But lowering interest rates, the way he has to do it is not by just saying, oh, interest rates are lower. And that could be the case on Fed funds rates or what the overnight rate is between what the Fed will loan a bank money if they have outstanding deposits that need to clear by the next day or so forth. That rate's, in the 4-ish range and was up closer to the 5-ish range. And it's come down a little bit because they have lowered interest rates 3 times, I think, last year and 1 time in just last month. But the Fed funds rate doesn't matter to mortgages and to what banks want to charge for loans. They can still charge 7% for a car loan or 10% for a credit card or 35% for a credit card. They can still charge what they want. So just because Jerome Powell says, hey, I'm going to lower interest rates on the overnight rate to banks doesn't mean anything to your real pocketbook and your own well-being unless the banks follow suit and decide to lower interest rates, which I don't think they can because they're already losing money. They have higher default rates than ever on car loans, on credit cards, on mortgages. Everything's at all-time highs. So the economic picture, in spite of what they say on the news or what even Jerome Powell says, is not necessarily true to most people that are suffering financial pinches and are late on their payments. And banks are having to deal with that. We're seeing banks' earnings come in and they're softer than normal. We usually see banks go crazy. Bank of America actually did earlier this week, but JP Morgan looks weak. Morgan Stanley looks weak. Citibank, shoot, that's a good short opportunity. That looks weak. There's a lot of big banks that just don't look like they're as strong during this earnings season that they have in past earnings seasons. So that's a troubling sign. The other thing is if Jerome Powell does lower interest rates and he wants to lower or make it so that it can filter into the economy, he's going to have to basically do quantitative easing, which is print money, give it to the banks and let them buy bonds. If they buy bonds, they usually buy bonds because they're being given this money. Basically, the Fed's printing money. The banks get these money to buy bonds and they drive the price of the bonds up. Now, that's good for bondholders. Bondholders that have lost 10 to 20% in the last few years could make a lot of that back in the next couple of years if they do some more quantitative easing. But we know what quantitative easing ends up doing, and that is create inflation because it creates more money. And only the rich seem to be able to take advantage of the bond market going up, the big hedge funds, the big pension funds, the rich people that have a lot of assets that can move to those assets and take advantage of the bond price increase. Most lay people don't really have that. Most people have been waiting on bonds, but haven't been making any money on bonds. Now, there is an opportunity, I think, going forward to make money on bonds if they do quantitative easing, but it's inflationary. Look what happened during the Biden administration. We had that big correction in 2022, and it was because the Fed had to start raising interest rates. That was harsh on the market because we know that companies love to borrow money at close to 0% interest so they can run their business. Well, now they can't borrow money at close to zero. But in order to make the companies and the stock market look healthy, the Fed's getting pressure to lower interest rates and even lower those longer-term interest rates so that those businesses can thrive. I think lower interest rates are going to make it harder for banks to make money. So that's why they need to print money to give them the money to invest because they don't want to invest their own in a 4% bond when they could loan it out to you for 7% on a car loan or 7% on a mortgage. So banks are trying to make their money where they can, getting a little thinner than usual. I believe that the inflationary pressures look like they're going to creep back in if Jerome Powell has his way and not only lowers the interest rate, which might make the market go up for now, but that extra increase in wealth, which typically only helps the top 1 to 2% of the economy, the people that own all the stocks the most, I don't know that it's going to help the middle class as much. So again, you have to be very careful as far as where you place your money. You look at the different sectors in the market that have done well. The AI sector has been really driving the market. But if that crashes, as Jamie Dimon said recently, everything's going to crash. A lot of big hedge fund managers are going to cash right now. We've known Warren Buffett's been doing that for the last few years. I've been saying that it's a good place to have most of your money. Now, most of our money is in fixed indexed annuities and LERPs and things like that have principal protection. So, if you do have 20 or 30% of your money that's at risk, it's not a life-changing event because we've already secured the safe money on our income and retirement plans. So it's okay to take risks, but again, do it on the money you can afford to risk, not the money you have to live on from month to month, or you might find yourself in a world of hurt and a lot of trouble and maybe looking for a new job in retirement. We don't want that to happen. So there's just a few things that are on my mind today. I did hear that the job openings report is down like 40 to 50% of what it was a year ago. It used to be a lot more companies hiring. There's a lot less companies hiring. They've had to downsize and they're looking for either part-time work or lower paying jobs to fill those. So I don't know, that just doesn't look like a super healthy economic picture. I'm not trying to be doom and gloom. I'm just saying what the news is, what the news behind the curtain is, not the one where we see just the guys out, the talking heads on the news that we see on the front of the TV that say everything's fine, because they don't want to rock our world and because they're getting paid by investment companies that want them to prop up and cheerlead the market. And if they don't, they're not going to give them their advertising dollars or go somewhere else. Somebody who does tell their story. So going forward, just like always, let's be cautious. Let's watch the market. Let's not get too excited. It looks like there's a lot of pressures of certain sectors of the market. Like I told you, the precious metals, the gold and silver really sold off hard this last week. And looks like we may still have some choppy road ahead of us. Maybe it'll solidify. Maybe the run's over. I don't know. It's been a great run. But I do think because of the precarious position in the market that the market is and the overvaluation that we're experiencing, that's what is propping up gold and silver. And the new quantitative easing is going to make bonds a little bit more of an attractive play going forward and maybe less attractive for the crazy high-tech stocks and maybe even some of the overvalued nuclear things. Anyway, I think the AI business might be a little bit stretched, but we'll see. The market always tells us the truth. It always knows. It's always right. We can be wrong about the market. The market's always right because it does what it does when the market wants to do it. So just kind of look at what's happening and make your best decision moving forward.
Our show is called Premier Retirement. We're talking with Jeff Ogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about current events and things in the headlines. Once again, if you're listening to this part of the program and you're asking yourself, boy, I'm not sure whether or not my portfolio is structured for times like these, you'd like to talk to Jeff, offering that opportunity right now at 520-780-9059. Make that call while you're listening to the program this weekend. Leave your name, telephone number. Shelley will call you back during the week and set up that appointment for you with Jeff. No cost, no obligation whatsoever. 520-780-9059. Also online at primrat.com. Jeff, you had mentioned Jerome Powell a couple of times there, and I understand that we could possibly have another rate cut here in October. Certainly there may be another one in December. A lot of people are thinking that this could be 25 basis points, a quarter of a point. Do you think that is accurate? Will we see 25 basis points here in October, or could it be as much as 50 basis points?
I don't think it'll be 50. I think he's going to be kind of cautious on that, especially when the rumor is, as I just mentioned, more printing money. It's more of the QE is going to be reestablished, which Trump might like it because it'll make the market good and make him not look like there's a crash on his watch. But he knows, too, that it's an inflationary issue. And if we can keep energy costs down and some of the other things, I think that'll curb the inflation aspect of the QE this time. But the QE always helps the market. And if they're going to do QE, I think that means that the market might be propped up. Unless it's so overvalued and there just becomes some sell-offs or people run scared. But as far as the rate cut, the 25 basis points, that's just the Fed funds rate. That's just the overnight rate. That doesn't really affect anything other than a short-term bond, like the 1 to 3 year bonds that are probably paying 4.3, 4.4% right now are probably going to go down to 4. That's still a decent rate of return as long as inflation's under 3, right? Because at least with safe, no-risk money, you're still keeping ahead of inflation. That's great. But does it really make the economy go better? Does it really help companies feel like hiring more people and paying them more? Does it make a situation where families can get out of their debt, that they can buy a new house and pay less on their mortgage? That Fed rate cut of 25 basis points doesn't make any difference in those aspects. It's only going to make a difference if they do quantitative easing and if banks can lower interest rates by buying up the bond rates and making mortgages look more attractive again, which I think is why Jerome Powell, I know the housing market has really been flat and very underperforming the last couple of years. And, even in Phoenix and Tucson, it looks like the market's down 20 to 30%. From its peak a little over a year ago. So prices are dropping that much. There's obviously some economics that need to be addressed here. And I think that's what Powell's going to do. I don't like quantitative easing. I would just love and as much as this sounds harsh, I would love for the market to correct in housing, stocks, everything basically, and come to more of a free market pricing situation rather than being manipulated by quantitative easing, extra money that mostly only the super rich really benefit by. And the rest of us seem to find that our dollars get stretched a little bit tighter and tighter, or aren't being stretched enough to make ends meet. So again, probably 0.25%, but I don't think it's going to filter through the economy other than it might make the stock market pop a little bit because they love rate cuts. It sounds good and the market usually reacts.
Talking with Jeff Ogan of Premier Retirement Planning and Wealth Management. Once again, our phone number 520-780-9059. Jeff, let's move on to our next topic here, and that is about alternative investments. When people hear the term, Jeff, alternative investments, what exactly are we talking about here?
Well, I think what they mean is anything other than stocks, bonds, and cash. Wall Street loves stocks, bonds, and cash. It's liquid. It can be moved around, could be traded, it charges fees. There's always that bid and ask difference, which is the margin between retail and wholesale price that they get to keep on the insides. I remember that's what we used to call it when we were stockbrokers back in the day, as what's the insides? I mean, how much profit is it if we buy and sell this here right now? And that's still out there. Yeah, that's all Wall Street does. And of course, Wall Street's big. Wall Street's the one that gets the most airtime, FaceTime, and everybody looks at that because when you do your 401ks and you grow your assets while you're working, that's pretty much all you have available. And there really aren't any alternative investments. What about private equity? We have private equity. In fact, we've had some private equity firms that have created a particular symbol or its own ticker symbol for us to trade in our group. We've got a group with about $130 billion of assets that I belong to. And together, we're all a whole bunch of independent offices, but together we have huge buying power. You know, when we have $100+ billion in assets under management, we can go to a private equity firm and say, hey, can you carve out $1 billion for us? We've got a bunch of accredited investors that would like to make 11% on their money and have some of the lending programs that you guys are offering. I'm just throwing out numbers, but you know, there are some alternative investments like that. Some people like to use REITs, real estate investment trusts. The only real estate investment trust I trust anymore is a publicly traded one. Sometimes we'll do publicly traded trust, but most REITs seem to be a Ponzi scheme where they come out and they raise money, they invest in real estate, they hope it grows in value, but they tell you it's going to pay you a 7% dividend or something like that, and they'll pay you that, but it's paying out of new money that is being gathered, not by proceeds, because they haven't typically sold any property for the first 4 or 5 years or even generated income, because a lot of those projects aren't necessarily generating income. So the new REITs, which typically have really nice commissions, so brokerage firms like to sell them, and independent reps like me sometimes like to sell them. But I learned back in the early, I think it was by the early 2000s, I learned that those were not for me or my client, because it seemed like every time they'd raise $100,000 from me, you'd make 7% a year for 5 or 6 years. And then they'd tender offer it out for like 60% of your money, which meant you barely got your money back. So in other words, they just use your money for free. So REITs are an alternative investment. Be careful how you buy them. I would not buy a brand new REIT, a new offering. I would buy only publicly traded REITs. Those also can be done with the ticker symbol. We can hold those in portfolios. We do that from time to time. Healthcare medical building seems to be kind of a hot topic, more so than, say, the typical office building or even strip malls and things like that, now that Amazon's sells you everything and you don't have to go to the stores or the strip malls and boutique shops to buy stuff anymore. So there are some areas there that still are attractive. Let's see, I would consider the alternative investments that we really like are the principal protected ones that are offered by insurance companies. You know, Wall Street hates insurance companies. My gosh, they take your money and they stick it in this annuity that never goes down and only goes up when the market goes up. Alert will do the same thing, the life insurance version of that, where it never goes down when the market goes down. The cash balance, now you do have to, on the insurance part, there are fees for the insurance, but you don't have to buy a ton of insurance. You can keep those fees small, the fees that are associated with insurance costs. Annuities, you can buy annuities that have fees but give you supercharged returns, or you can buy them without fees and still get upside with no downside risk. Those are alternative investments. Wall Street hates them. They typically don't pay us as much over the long haul, but they make our clients really satisfied and really happy to have some assets that they know is always going to be there. They're always going to be safe and protected. So we like indexed annuities, fixed index annuities particularly. We even like the multi-year guaranteed annuities. We call them MYGAs, multi-year guaranteed annuities, like let's just say a 6-year CD that, can you find a 6-year CD right now that pays more than 5? No. Well, there's probably 10 companies right on the tip of my tongue or on the top of my head that I would say will give you more than 5 guaranteed for 4 or 5 years in a tax-deferred account. You don't have to pay taxes every year like you do on a CD. In an annuity alternative, and you can pull the interest out every year if you want to, or a certain amount of liquidity depending on the product. So they're very friendly, can pay more interest. They just don't happen to be Wall Street products, and Wall Street brokerage firms, banks hate them because they're not what they sell. And being independent, we can offer both those types of products, alternatives and Wall Street type stuff. LERPs, kind of the similar thing. If you like tax-free income, if you like tax-free growth, if you like a nice tax-free death benefit for your heirs, if you like access to that death benefit before you die for long-term care insurance. I've talked about all these things. I'm kind of skipping over the facts kind of in bullet point fashion here. So if you haven't heard the radio program before, you might want to get a little bit more detail on that, but just listen more often. You'll kind of have the pieces fall into place. But bottom line is, yeah, we do alternative investments. We don't think that you can build a house with just a saw and a hammer. There might be some other things you need along the way. Wall Street thinks you can build everything you want with a stock and a bond, and we don't think so. We think there's stuff that's out there that is better for planning for tax, better for income, better for principal protection, peace of mind, better for liquidity, better things for growth. We trade portfolios for growth. We also have some highly leveraged indexed annuities that have principal protection with some leveraged growth. A lot of stuff. So yeah, we use alternative investments. We think you should never take anything off the table. There's products out there that are created because they fill a need. You might not even know that you have that need. Maybe you don't even know that that product exists. Maybe you have a product, you have a need, you just didn't realize that a stock and bond wasn't the best way to fill it. There's other things that might do it better. So heck yeah, we use every tool in the bag. We use alternative investments. The world's our oyster. We don't believe that we should be limited in the products and services that we offer.
Jeff, one of the things that I hear when we mention alternative investments is the issue of liquidity. Can you comment on that?
Well, that's true. There is a liquidity issue with alternative investments. Retirement planning is typically a 30-year plan if you're 60 or 70, right? We don't plan to ever liquidate all of it. Most alternative investments, there's not very many that tie your money up and don't pay you at least some interest along the way. There are some that do. You don't want to put all your money in them, obviously. But let's say you have $1 million and you have half of it you put into an annuity that pays you $50,000 a year. I'm just using some round numbers. And gives you all the income over and above your Social Security that you need. So you've got another $500,000 that you can play with. Maybe you always want to have a couple $100,000 that's liquid. So you have that in maybe some short-term bonds for some quick liquidity and safety. And then you have some growth portfolio that, we jump on gold when it's hot. We jump on, I don't think I'm supposed to use the word hot. That's like a non-compliant word. But, the things is certain things get hot, certain things get cold. There are times when AI is a good investment lately. Nuclear energy is a good investment lately. While gas and oil aren't really a good investment, we can look at those opportunities and invest in those. So that could be your liquid money. And then maybe we have a private equity fund that pays a 10% dividend that holds its value pretty solid. You can liquidate up to a quarter of it every time you ask for your money, and it could be done on a quarterly basis. So they're somewhat liquid. There are some that just have okay, you're tying this up for 5 years, you can't touch it. And at the end of 5 years, we'll see what it's worth. Sometimes those REITs that I talked about earlier work like that. While some pay interest, some may not. It could be just a 5-year note where it balloons at the end and whatever they can get out of it, you get. And that's why some alternative investments, I like the ones that have a ticker symbol that can be traded. Publicly traded REITs are, even though they're a security, they're kind of an alternative type of an investment because they're real estate based, but they can be traded. You can trade them in and out of them liquid all day long. So there are some liquid versions of private equity and liquid versions of alternative investments. There's also, liquidity issues. And basically on an annuity, for example, if you're going to get 30 years of income out of it, why do you need it to be liquid? It's going to be liquid over 30 years. So who cares? However, what if you're not going to make it 30 years and all of a sudden you find out you're going to a nursing home, you have a terminal illness? Guess what? It becomes totally liquid on those indexed annuities that I talked about. LIRPs also, you don't have to die to get the death benefit. You can actually spend it if you get sick, or if you even if you want to cash those things in, you can cash them in. Sometimes there's a back end load or a penalty, but so what? You could lose a lot more than that in a bad week in the stock market typically. So, the liquidity issue, some are a little bit more tied up than others. So the reason that we love alternative investments for the benefits that they provide, but you never want to put all your money into something that limits your liquidity. I mean, you have to always have enough liquidity that's a sane amount or a sensible amount. And we provide that with $1 million. You don't have to have all $1 million tied up, but you don't have to have all $1 million liquid either, because nobody's going to probably spend $1 million in 1 year if that's their entire savings. So again, it's all about making the plan, using all the tools, using them in the right proportions according to the person's needs.
Jeff, I want to talk to our listeners here in just a moment. If you're not sure whether alternative investments are right for your portfolio, you want to explore these options, give us a call here at Premier Retirement at 520-780-9059 to begin that conversation. No cost, no obligation whatsoever. 520-780-9059. You can also find out more about us online at premred.com. Jeff, let's take a break. When we come back here on Premier Retirement, we're going to be answering listener questions, and then later on in the program, why your estate plan should change. When our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premred.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you so much for making this part of your weekend. You're listening to Premier Retirement with Jeff Ogan here on 790 KNST. We're here for you on the radio frequently, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and then on Sundays at 11 a.m. If you miss us any of those times, you want to hear the whole show over again, remember we're also a podcast. Go to wherever you get your podcast. Search for Premier Retirement with Jeff Ogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident and a prosperous retirement. Again, 520-780-9059 is our telephone number. If you'd like to come in and sit down and talk with Jeff about your individual retirement concerns or just growing your wealth, we've got a lot of tools in the toolbox here. Let us show you how they work to enhance your portfolio. Again, no cost, no obligation at 520-780-9059. And again, you can find out more about us online at premred.com. Jeff, time for listener questions. Let's kick it off with John listening to us in Tucson this week. And John says, my spouse and I are in our 80s and do not have long-term nursing home insurance. We currently have about $2,500 per month in income, more than we need for monthly expenses. I want to purchase CDs to start self-insurance accounts to pay for possible nursing home care. Do you think this is a good idea?
Well, I think it's a good idea. There are some alternatives to the CD method. There are some annuities, by the way, the indexed annuities that have a typical historical and average rate of return much bigger than CDs. And there's a few that might actually give you an enhancement to the actual value. For example, there's one that I'm thinking of that may or may not be available depending on how into your 80s you are, because most of them are age-related. The longer your life expectancy left, the more excited you should be about the annuity options. But there are still some that might be available. And for those that maybe aren't 80 that are listening, maybe this is an idea to cover long-term care. But there are enhancements to annuities that would actually give you more than the interest you make should you need it for nursing home, kind of like a little extra bonus. Now, the insurance companies know that they're not going to have to pay for everybody to use that annuity in a nursing home, so they can usually diversify their own risk by paying you a reasonable rate of return and having some money in the coffers for those people that might need that enhancement for nursing home. So it's a deal that works. It's a win-win for both the insurance company that offers those as well as the purchaser of those. The other thing that, based on the fact that you're in your 80s, you can't, if you were in your 60s, I'd say check a LURP out, because you get multiples of what you put in as a death benefit, and you can use that death benefit for nursing home insurance should you need it for that. I think just having a savings account that, if it's over and above what you're spending anyway, is great to sock away and do something. I think CDs are a good way because they're at least principal protected. The problem is I think CD rates are going to be started to go down. I think you can make more money on some other things. You could even make more money on a fixed annuity that pays more than a CD that is tax deferred. So you can also add those taxes that you save to that potential long-term care plan that you're trying to do on your own. One thing that I think people overlook is the equity they have in their home. And I think the equity in their home is certainly an asset you've paid for, you've earned. It's like a bank account, but nobody knows how to use it. It's something that we offer here. People somehow have a misconception that it's a horrible thing, is a reverse mortgage. Fact is, you've got a whole bunch of your own money tied up in your house. And that's great that you have a house with no payment. However, how would you like to keep that house with no payment, but be able to spend some of that equity in case you need it for a nursing home? Now, what a lot of my clients that aren't ready for a nursing home yet do, that are still lucid and totally okay, is you can actually get a reverse mortgage line of credit where you don't actually take a mortgage, you don't even take a payment out, but you set it up to where you have a line of credit against your house should you need it. And right now, that line of credit grows. Let me just give you an example. If you had an $800,000 house, now my son Jordan is the one that's really the expert in this. He's a mortgage guy, and he was from the real estate and mortgage business before he joined me at Premier. And so he just kept his licenses, and I said, bring them on over here, because if we have clients that want to list property and reverse mortgages, we need you. So rather than refer you out to somebody that's going to ding on extra fees, we can do it on pretty much a wholesale basis. So I've learned a little bit about this and find out how good they are. In fact, I think people that are wealthy end up using it more often than people that aren't. People that aren't maybe are a little less sophisticated and more skeptical of them. But here's how it works. Let's say you have an $800,000 house, and let's say you borrow $400,000. But let's say you don't even borrow $400,000. You just get a credit line. And let's say that $400,000 credit line grows at 5% a year because that's what interest rates are growing. So maybe by the time you need a nursing home, you have a credit line of $500,000. Well, now your home's worth $1 million. So you go to a nursing home, and what if you spent $300,000 on a nursing home, but you didn't have to cash in investments, you didn't have to move your spouse out of the house because he or she wants to still live there until she passes. And so let's say you use $300,000 of that credit line and on your nursing home, and then you pass away. Spouse is left in the home, still worth $1 million. You've got a $300,000 debt that you've used. And let's say in 5 more years, the next spouse goes to a nursing home, and now your house is worth $1.2 million, but your credit line's now worth $600,000. You use $300,000. There's another $300,000 left. So second spouse dies, you have to give the bank back. And I'm using this in simple terms, but you have to give back the $600,000 that you spent, but you didn't have to cash in your stocks. You didn't have to blow through all your IRA money. You didn't have to sell your house. You didn't have to sell your assets. You still got to use that $250 a month that you're saving in CDs. Instead, you got to go travel and do some stuff and live with a little bit more confidence in your long-term care plan, where you didn't have to feel like you had to be a penny pincher in order to save for that long-term care. You always got that ace in the hole. And then guess what? Whoever your heirs are will still get the balance of that account of whatever is left in your house. So that $600,000 equity would still go to your heirs. You never needed to go to the nursing home, but you did this anyway. Okay, well, you put away a little bit of extra money in case. You got to use your $2,500 a month for fun and stuff rather than penny pinching and living tight, and then ended up not needing nursing care. And all you did was give a whole bunch of CD money to your kids or your heirs who didn't really need it anyway. So why not take advantage of living life on your own terms, spending the money that you make, having that bank that's called your house be your backup plan for your long-term care plan? That's another way to look at it. And if you don't end up using it, guess what? You end up giving your kids $1 million home or $1.2 million or whatever the home's worth, and they get that asset they can sell and divide. Plus, the house would get a step up in basis. They wouldn't owe any taxes, whereas you'd be paying taxes on the interest on that CD money the whole time. Or if you took less out of your IRAs and 401ks and things like that, you're not passing on a tax burden to your heirs. Don't overlook your house as an alternative to that CD plan for long-term care.
John, good question. Thanks for sending it in to us. And of course, you'll get Jeff's book, Retirement, The Road Ahead. And again, if you have questions for Jeff, 520-780-9059. Jeff, let's move on now to Chris in Catalina Foothills. Chris says, I really enjoy your show every week and your in-depth analysis. Thank you so much, Chris. I'm retired, and my question is about allocation. A total world stock index says the S&P 500 companies make up about 60% of the total holding for the stock portion of my portfolio. What is the downside of only holding the total world stock index? And I guess first off, Jeff, what is the total world stock index?
Well, I've never used that total world stock index. I think the whole world, I guess over a 20 or 30 or 40 year period, the total world stock index would probably be just fine and end up making money. But the thing is, different countries are going into different economic cycles at different times. As we've emerged out of the COVID era, a lot of the European countries have done very well, but China and Japan haven't done as well. I guess Japan had a little streak there. Now we're looking at Korea doing well, but China isn't doing well. I think a lot of people are looking at Korea as an alternative to China for purchasing items and kind of offsetting some of this tariff war thing that we're having with China. I don't know. If you're not managing your money, you just hate fees, and you don't want to use an advisor that can do a lot better job for you, then maybe you just do that and say, oh, well, let's just see what the world does. I don't even like that theory, honestly. It just doesn't sync with my brain. Since we deal in dollars, just the dollar valuation is going to have an effect on how the rest of the world works, especially if you're buying the S&P World Index with dollars. So the fact is the world trades in different currencies, and they may or may not be in favor with the dollar at any given time, or they may be out of favor. And it may be in better interest to get into those things. We've had India and Pakistan were rolling for a while, maybe not so much anymore. Maybe Europe was really in the tank, but now it's doing better. I think if you're going to do just one index and hold it long term, probably the S&P 500 or the NASDAQ or Dow would probably be the best indexes to have, just because it's in parity with what's going on in America. And we typically seem to have a more even keel level of growth. But yeah, I don't know. It's one of those things I haven't really looked into or even felt like looking into, because I think we do a lot better job following the money and just seeing what economies are doing well and going into those markets when they're more appropriate.
Chris, thanks a lot for that question. Thanks for listening to us in Catalina Foothills. Again, 520-780-9059 is our number if you'd like to talk about the total world stock index there and how it may apply to you and your portfolio. Richard is hearing us in Vail, and Richard says, I built up over the years a sizable estate well into 7 figures. It involves real estate holdings and business interest as well as equities. I'd like to avoid public disclosure of my assets. I have a golf buddy who uses a family trust. Can you explain the benefits of a family trust and whether or not it might be right for me?
Yeah, I like family trusts. I mean, I use them. Most of our clients have them. That's one of our 5 pillars of planning, is a legacy plan. How do you give your stuff to who you want, how you want, with the least amount of trouble, taxes, no probate, and no public disclosure? One of the things I learned when I was a stockbroker years ago is a couple of people in my office used to go down to probate court to find out who was inheriting money. So they find out where those 7-figure estates were going, and they'd contact and wine and dine the heirs until they finally got the money. And that's how they'd pick up some nice clients. But if you don't want that process to be public, then you should keep it in trust and just let those assets pass based on a trust. A trust is kind of like just for figurative speaking over the radio, it's just like if you have a big box, you just put everything in it, but you're the owner of the box and you can get anything out of the box and use it anytime you want to, and you put it in the box. And when you die, you just hand the box off. In other words, somebody else is the keeper of the box, keeper of the trust. It's basically putting a beneficiary on everything you own, and it could be your kids or a friend. I don't like attorneys or trust companies. They usually charge too much and they don't do any better job than somebody you trust generally. Unless you have a bunch of irresponsible or special needs people, then maybe you do need a fiduciary or a company to deal with it. But typically the heirs can be the trustees and just take their assets, kind of like pick up truck estate planning. They just show up and take what's theirs and move on. And you can divide the assets through the trust without any public disclosure other than to the trustee. The heirs generally have a right to know, but you can keep it all in the family with the trust. I like trust. I'm a certified estate planner. We've done trust for thousands of clients over the years.
Richard, I hope that answers your question. We appreciate you listening to us in Vail. And again, if you'd like to talk to Jeff, 520-780-9059. Of course, you can find out more about us online at premret.com. That is PREMRET.com. If you've got a question you'd like us to answer on the air, you can get it to us two ways. One of which is you can call it in to Shelley. She'll take it down for you at 520-780-9059. The other way is to go to our website, which is premret.com, put it in the contact page there, and if we use it on the air, not only will you get a great answer, but you'll also get Jeff's book, Retirement, The Road Ahead. 520-780-9059. You're listening to Premier Retirement with Jeff Hogan. My name's Jeff Shade, and we're here for you on the radio each week for your fiscal fitness and your financial education. Jeff, let's shift to our final topic here, and this is why your estate plan should change. You've said before that life rarely stays the same, and neither should your estate plan. Why is that?
Well, we know life is fluid. Everything changes, but I think your estate plan needs to be flexible. I think your retirement plan needs to be somewhat flexible. A plan is kind of a road with direction, has guardrails on it. Hopefully you don't have to jump the guardrails and rechange the plan. But basically, with an estate plan, sometimes your heirs turn weird or die, or somebody dies, or you inherit money. You have a different situation. So I think any part of your plan needs to be flexible just because life is flexible.
Jeff, let's talk about the basics of an estate plan. I think most people are familiar with the terms will and trust. When is a will good enough, and should you always have a trust along with a will?
A will is really a probate document. It goes to court, and it's basically, read in court, read in a public forum. Things are made public. It gives a chance for people to come in and contest it. I don't like wills. Now, it's good to have a backup will. We call it, in our trust package, we put a pour-over will in there, which pours over to anything that somehow might have got left out that has to go through probate and has to be adjudicated in a court situation. And if you can avoid that, obviously you're avoiding time, money, and frustration for your heirs. So we like a trust as an alternative. Now, you don't always need a trust. A direct beneficiary listed on everything you own can also make that process happen without probate or without needing a will. If you have an IRA and you put 3 of your kids on, a third each, and if one of your kids dies, you can check a box that says per stirpes, meaning that their third would go to their kids based on how many kids they have, divided equally. You could set that up just on a form, just on the account when you open it up at Fidelity for your IRA or whatever, and solve the probate problem. Everybody just makes their claim, they get their money out, just do what they want. If you want to leave it in trust and have a trustee pass it out according to your desires, for example, maybe you don't want one of your kids to have a third of your assets all in lump sum because you know that they're not good with money. Or I had a client that, his kid was in and out of rehab and they were scared what it would do if that guy had a pile of money that might tempt him to get in a bad situation again and need rehab again. So, had sister monitor that money to where she would give him all the living expenses he needed, but not in any lump sums. And so you can put things in trust and have those assets passed out the way that you want to through the trustee. And that is somebody that you trust. The court typically doesn't always care what you think. They'll do whatever they decide in the end, what your will meant. But I don't like the idea of courts and lawyers and people that you don't know that aren't in your family being involved in your estate. So we try to keep them out of it, either through beneficiary designations. And by the way, it used to be that if you had a home, you had to have a trust in order to make that house or real estate go through probate. But now they have in Arizona and I think 10 or 12 other states, they have what's called a beneficiary deed where you can actually file a deed at the county recorder And it says that, if they can produce a death certificate, then that house or property would be divided amongst those people listed as beneficiaries on the deed. So if that house would ever be sold, then in escrow, basically the title company had worked that out to where they just issue each child a check for the portion of equity that was theirs. So you can get away with beneficiary designations. Now, I would say in a trust package, we typically include powers of attorney, living wills, and a lot of what we call ancillary documents that help for living probate, things that aren't necessarily what happens to your stuff when you die, but what happens to you while you're living, but can't make decisions for yourself, or, are on life support and somebody has to make that decision to say, hey, let's cease life support, let them die in dignity rather than linger and milk the insurance for more of our money while this person suffers and is going to meet their maker anyway. So those documents are important. If you don't end up having a will and don't have a trust, but you do have everything listed with beneficiaries on it, don't overlook the fact that you may need powers of attorney for those things that happen between now and the time you pass away, and have somebody on there that can help you manage those aspects of your life. I think sometimes when people do a trust, they get all that and they think everything's hunky-dory. People say, oh, I don't need a trust. I did my beneficiary, so I don't need anything. Well, you do need those other documents. So we have a will package that we put together for those people that do beneficiaries. It's less money, it's less work, less documents, but it has a backup will just in case you need it. And then it has those powers of attorney and things that almost everybody ends up needing at some time in their life. And so don't overlook those, what we call the ancillary documents.
Jeff, I am shocked at the number of people that I run across who do not have a will or a trust. If someone dies without a will, it's called dying intestate. What does that involve and what's going to happen?
Basically, the intestate succession is the probate code of the court in your state. It says basically who's entitled to your assets. It might be parents, siblings, kids, grandkids, typically not neighbors and friends, but typically relatives that are somehow blood related or either directly or distantly related to you. And if you want all your assets to go to your kids, but you have other siblings and stuff throw in their claims, the court might distribute your assets in a totally different way. Or if maybe you've already helped one of your children out through college and through hardships and so forth, and say, that person's got pretty much everything, I want to go to that person. Well, you better have something that says so, because if you don't, then the court will probably just divide it up however the court sees fit. So if you want to be in control of your assets, do it in estate plan. Make sure that you're in control because it's your stuff. You ought to leave it to who you want, how you want.
Jeff, with all the online tools that are available out there, some people, I think, listening to the show today are wondering if they really need an estate planning attorney. What do you think?
No, I don't think so. I mean, we used to use an estate planning attorney, not for about 90% of the work. Some people can even do it online if you're savvy and you can kind of get the programs and fill one out that's state specific. I will say Arizona is one of the easygoing states that probably isn't going to be too picky about the form you use if you want to do it yourself. I found out years ago that the attorney I was sending everybody to was really overcharging, wasn't even doing the work. He had a girl in the office who's a certified document preparer that actually has to certify with the Supreme Court. So they have to actually prove competence in drafting these documents. And one day she called me and said, hey, Tom, the attorney isn't doing trusts anymore. And I said, yeah, I heard. What's going on? She says, well, he makes more money suing people, basically. I'm trying to paraphrase here, but she says, but I'll still do your trust. I go, what do you mean? I thought you were the secretary that called my clients just to verify their address and name and all that stuff. And she goes, no, I've been doing the trust for Tom for years. She says, I've done, hundreds of your trusts. And I said, oh. I said, well, I thought Tom did him. She laughed. She says, Tom doesn't even know how to spell trust. He has other stuff, but he's a lawyer. Just because you're a lawyer doesn't necessarily mean you're really good at trust. So I just kept her on board. I said, shoot, yeah. She does them at night at home for me. She does the same form that she'd do if she was in an attorney's office, but for a lot less money. So, we save our clients, get the same work. And if we ever need a change or an update, she'll take care of it. And if she ever gets out of business, gets hit by a truck, an attorney could still update it for more money. But right now, we're able to do the same work with less money. And so kind of that happy medium between, I don't want to pay thousands of dollars for a trust. I want to just buy a $200 kit on the internet and hope it works. You can spend in the neighborhood of $1,000 and get a complete trust package and not have to worry about if it's done right.
Now, Jeff, I know that you're a certified estate planner. You're not necessarily an attorney, but you do have attorneys to write these things up. What should someone bring to that first meeting with you as a certified estate planner?
Well, it depends. We do comprehensive planning here. We're not just like a trust shop where you come and buy trust necessarily, but we do trust for all of our clients. If you have an overview of your estate, what you want to do with it, the names of your heirs and trustees and so forth, typically the first visit is really just to get to know each other and see if we want to do business together, but also to figure out how to set up a trust in the way that you want and to make sure that the right people are going to get what you leave and the right people are going to be in charge of your things when you aren't able to be in charge of them anymore. So it's really just more of an information gathering process. It's a little bit different than, say, somebody that's coming to roll all their assets over. However, most of our clients, we don't really do a whole lot of trust-only clients. Most of our clients are clients first, and then we make sure that the trust gets done. So we already have all the financial information, the things to help them plan and fund their trust. But if they just want to use our service to jump in and get the trust services done, we can do that on still a discounted from an attorney basis, but they would have to do the funding and make sure that all those accounts were, the name of the trust was put in the appropriate places on those accounts. But we would give them instructions on how to do that.
Jeff, I'd like examples. Can you give us a real life example as to how this would work?
Yeah, let's say John and Jane Doe, they have a trust, they have 3 kids. One of their kids lives out of the country. One of their kids is not very good with money, and the other person lives close by and is a CPA and super straightforward, honest dude. So, hey, who would you pick? So they decide, even though they want all 3 of their children to get their assets, they know that the person, that's out of the country probably has a hard time getting back in time to do any hard things, especially with pre-probate items like powers of attorney and so forth. So the local person that's responsible probably is going to be their first choice in a trustee, meaning the successor person that takes over managing their assets and distributing them after their demise. Also, that would be the person that would be in charge of paying the bills, making decisions on healthcare and so forth if John or Jane Doe, the parents, aren't able to do that on their own and the other spouse isn't available to do that for them as well. So let's say mom and dad pass away. John Jr. is going to inherit the duties of doing the trustee. So he would basically gather the information. He would send out death certificates to all the institutions that have those accounts. And, if it's us, they basically just give us a death certificate and we handle it because that's part of the guarantee that we give our clients is like, hey, when something happens to you, if we're doing your trust and we've got all your assets, we're going to make sure that it gets handled very easily and simply and with the least amount of trouble for your heirs. And we'll even fill out the paperwork and the claim forms and things like that for you. If not, then the trustee would fill out those claim forms, would get those assets. They would have to get a tax ID number for the trust where they would actually deposit all the money. Then they'd end up distributing it to each of the heirs. Now, maybe the one that is a spendaholic, let's say the one overseas gets their share outright. Let's say each person gets $1 million in total. So the $1 million gets sent over to Debbie over in Europe where she's living. John Jr. takes his share, and then Carl, the guy that's not too good at spending money, his gets put into a trust where he gets, $6,000 a month till the money runs out because that's what it takes for him to make ends meet and take care of his kids, grandkids, and so forth. So again, you could set it up any way you want to, and then you just pick who's in charge of making sure that happens.
Jeff, our listeners have questions about trust. You'd like to talk to Jeff about that. 520-780-9059 is our number. We'd be happy to talk to you, no cost, no obligation. Jeff, out of time for this week. I want to thank you for your time. But as I do every week, I want to thank our great listeners for joining us here in the greater Tucson area. So for Jeff Hogan, I'm Jeff Shade, wishing you a great weekend. Thanks for listening. Be sure to join us again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.